In my last video, we took a deep dive into market concentration, that is, to what degree a stock market is dominated by a handful of firms, and what impact this could have on long-term returns. So if you haven't seen it, I strongly suggest you check that one out first, and then you jump back here. To summarize, even though other countries have similar levels of market concentration, it is historically high in the US. And you can observe that during periods of falling concentration after it has peaked, the S&P 500 tends to have lower returns on average. Some argue that high levels of market concentration introduces individual company risk to a buy and hold portfolio, basically lowering your diversification. And in this video, I want to go through some alternatives for those who are worried about this. And it's not recommendations, it's just what I have come across after reading about this that I wanted to share. S&P 500 is a market cap weighted index of the 500 largest stocks in the US. That is a lot of stocks, but actually it only covers around 80% of the US stock market. So you could instead look into an index that covers 100% of the market. And the CRSP Total Market Index does just that. And this index is tracked by ETFs like Vanguard Total US Stock Market Index Fund. And just because now you have more stocks, the top 10 holdings will represent a smaller share compared to the S&P 500. But not that much different. To be fair, this alternative is a bit meh.
I mean, it's alright.
The difference between S&P 500 and the total US is quite small. Those extra 20% doesn't matter that much. What matters more are the large companies. Next up, we have the index recommended by Goldman Sachs over the S&P 500 for the next 10 years. Instead of weighting each stock in the S&P 500 based on its market cap, you instead split the allocation equally between all stocks regardless of their size. Every stock aims to have the same weight in the index. So by construction, you now have less exposure to the largest names in the S&P 500.
Get a close-up, get a close-up, get a close-up of the case.
Now, why do these guys recommend this index over the S&P 500 for the next decade? Well, it's because there's a natural link between changes in market concentration and the relative performance of the equal-weighted index versus the market-weighted index. In a market cap-weighted index, increased concentration means that the larger stocks have grown in price more than the smaller ones. Thus, if you had split your allocation equally among all stocks, would have underperformed, since relative to a market cap weighted index, you have a smaller allocation to these larger companies. You can also see this historically. We see a positive correlation between the starting level of market concentration and the relative return of an equal weighted index 10 years later. So it's basically a reflection of the same thing. But how has an equal weighted index performed historically? Starting from 1970, the equal weighted portfolio has outperformed big time. But even though plots like these might look impressive, they're sensitive to the starting point chosen. Looking from 2004, the median annualized return for the market cap index has been higher, but the outperformance has been strongest during the past decade. Now, here are my main issues with this index. So an equal weighted portfolio is quite an active portfolio as opposed to a passive one. A market cap weighted index works as a buy and hold portfolio where the weights are in a way decided by the market as a whole. If a company has a higher market value, it will have a higher weight in the index. Therefore, it relies a bit on the assumption that the market is efficient, that there's information in these market values. Equally weighted, on the other hand, does the opposite. It takes an active bet away from market consensus by splitting the allocation equally among all the stocks. And you can never really have exactly equal weights. Let's say on day one, you set up an equally weighted portfolio. On the next day, some of the stocks will go up and some will go down. And at the close, you will no longer have an equally weighted portfolio, since the best performers are now a larger share of the portfolio. Equally weighted indices will reshuffle their portfolio, let's say every quarter or so, but you will never really have an exact weight. And remember, every quarter you have to then sell the winners and you have to buy the losers, and you have to keep doing that because that is your methodology. And this is going to lead to higher transaction costs that's going to show up as a higher management fee for these funds. And if you were to switch from the S&P 500 to its equally weighted bro because of the current level of market concentration, know that you are engaging in market timing. To illustrate this, here's a paper from S&P Dow Jones saying higher concentration in the S&P 500 could lead to equal weight outperformance. Here's another one from Goldman Sachs, again warning about market concentration. Now, this was written in 2018 and this one in 2020, and the S&P 500 did still outperform equal weighted. An equal weighted S&P 500 is going to be allocated more to relatively smaller stocks, and they're going to look a bit more cheap compared to the mega caps. And it's quite a blunt tool to achieve that, so you might be better off just investing in a mid-cap value fund or a small-cap one directly. Combining this with a portfolio of large companies with high earnings growth, you get a quite nice combination that has outperformed the S&P 500 historically. Now, more recently, this combination looks to have performed quite in line with the S&P 500. And even if these two portfolios were to converge, you would still be less exposed to a handful of companies than if you were to invest in the S&P 500. And it's a simple approach, just two funds. Now, I think the best solution, if you're concerned about market concentration in a single market like the US, is to simply increase your international exposure. In US dollar terms, the US equity market has outperformed the rest of the world as a group.
Americans, everybody. I hate all you motherfuckers.
Will the US continue to outperform the rest of the world as a group for the next decades? Now, this is
Entirely possible,
but I wouldn't bet on it entirely. Therefore, I think it's fine to add some international exposure.
I gotta tell you, I'm really excited about this. I feel like this could be one of those defining moments of my life.
Yeah, I actually think it's not going to work out, but I'm pulling for your root.
From a US dollar investor's perspective, investing in international stocks means that you're going to be exposed to movements in a local currency. All else equal, if the local currencies are appreciating against the dollar, your international stock investment will get a boost when converted back into US dollars. And the opposite holds for a depreciation of the currencies. And you can see this quite clearly when looking at changes in the dollar and stock returns for the US, international stocks as a whole, and also if we separate so-called emerging markets, which have been especially sensitive to the dollar. Now, if currency movements cancel out over time, international stocks can provide some diversification. And again, this is easily done today with low-cost passive index funds. Now, the simplest but slightly more expensive route is to invest in one single global fund. There are a few of these, like the Total Global Stock Market ETF, VT, from Vanguard, for example, where the top 10 holdings only represent less than 20% of the portfolio. But relatively speaking, these funds are not that popular because most clients are from the US and they prefer a higher allocation to their home market than exists in these funds. So a more popular method is to use at least two funds, one fund for US exposure and one for the rest of the world. You can also split the rest of the world further into developed and emerging markets. Now, I'm not a huge fan of this distinction because I think it's a bit old and arbitrary at times.
What about that shadowy place?
That's beyond our borders. Let's never go there.
But it's true that, broadly speaking, companies included in the developed market indices tends to be more incorporated in jurisdictions with better accounting standards, shareholder rights, and are more transparent. And these are all good things if you are an investor in these companies. And emerging market funds tends to be more volatile. However, they can provide better diversification since the correlation between the US and emerging market indices tends to be lower than the one for developed markets. Again, the US dollar plays a role here. To tilt away from the US, you could decrease your allocation to the US fund and increase into both the developed market excluding the US and emerging markets. Now, this portfolio has been more volatile in the past and has trailed the 100% US in terms of performance, only beating the US for some years.
Just wanted passion from you.
I know.
Oh my god.
But remember, it's only backtest and we don't know how the next 10 years are going to look like. But I think all of this just highlights the importance of diversification when it comes to long-term returns for a passive portfolio. I hope you find this video useful, and if I can ask one little favor from you is for you to like the video and subscribe if you haven't done so.
Hate me or love me. Watched. That's all you could do. Thank you.